January 25th, 2025. A single piece of news crosses financial terminals worldwide. A Chinese AI startup called DeepSeek has built a model comparable to the best American AI at a fraction of the cost. Within hours, NVIDIA's stock drops 17% in a single trading day. Nearly $600 billion in market value evaporated before sunset. The largest single-day market cap loss in stock history. By the following morning, markets recovered partially. Analysts call it an overreaction. Investors returned. But here's the question nobody asked loudly enough. If one Chinese announcement can erase $600 billion in a single afternoon, what happens when the underlying math of the entire AI investment cycle stops working? Because right now, in 2026, the numbers behind the AI boom are telling a story that the stock prices haven't priced in yet. Total AI capital expenditure from just 4 companies, Amazon, Alphabet, Meta, and Microsoft, reached nearly $300 billion in 2025 alone. For 2026, that number is projected to rise to $500 billion combined. Against that, total global AI revenue is estimated at less than $50 billion. $500 billion going in, $50 billion coming out, 95% reporting zero return. This isn't early-stage growing pains. This is a structural liquidity problem building in plain sight. .com pattern. To understand where this ends, you need to understand where it began. March 10, 1900. The Nasdaq peaks at 5,048 points. Every major investment bank is bullish. Every analyst is upgrading price targets. Retail investors are pouring savings into .com stocks because the internet is going to change everything. It was going to change everything. They were right about that. But between 1995 and March 2000, the Nasdaq had risen 582%. Companies with no revenue, no profit, and no viable business model were valued at billions of dollars because investors believed future growth would justify present prices. Then, on March 11, 2000, the selling began. Within 1 month, nearly $1 trillion in market value had evaporated. By October 2002, the Nasdaq had fallen 78% from its peak. $5 trillion in total market value was destroyed. The mechanism behind the crash wasn't simply overvaluation, it was a liquidity crisis. When the Federal Reserve raised interest rates 6 times between 1999 and 2000, venture capital dried up. Startups burning cash on the assumption that new funding rounds would arrive found the funding gone. Companies with 18 months of runway collapsed when the next round never came. When liquidity contracts, everything dependent on future funding collapses simultaneously. Not gradually, simultaneously. Now, look at what's being built in 2026. Revenue gap. OpenAI is committed to investing $1.4 trillion over 8 years in data centers. Its projected revenue for 2025 is $13 billion. Its operating loss for 2025 is $8 billion. By OpenAI's own forecasts, annual losses will double to $17 billion in 2026, then double again to $35 billion in 2027. Against $500 billion in annual AI capital expenditure, AI revenues need to reach $400 to $500 billion annually just to break even on 1 year's investment. Meanwhile, despite $30 to $40 billion in enterprise investment in generative AI, 95% of organizations are getting zero measurable return. $500 billion going in, $50 billion coming out. 95% reporting zero return. This isn't early-stage growing pains. This is a structural liquidity problem building in plain sight. Circular financing. In the .com era, the warning sign was companies investing in each other to create the appearance of revenue without creating real economic activity. In 2026, the same structure has emerged in AI at a scale that dwarfs the .com era. Consider the chain. NVIDIA made a $100 billion investment into OpenAI. OpenAI simultaneously took a 10% stake in AMD. Microsoft, a major OpenAI shareholder, is also a major customer of CoreWeave, an AI cloud company in which NVIDIA holds significant equity. Microsoft accounted for nearly 20% of NVIDIA's revenue in its 2025 fiscal year. The same dollars are circulating through interconnected balance sheets, each transaction inflating the valuation of the next company in the chain. When circular financing unwinds in a liquidity crisis, the unwinding accelerates. Each company's falling valuation damages the balance sheet of every other company in the chain. Debt mechanism. After Oracle sold $18 billion in bonds in September 2025, its stock dropped 5.6% the next day. Since that bond sale, Oracle is down 37%. Half of all data center spending through 2028 is funded by debt, not earnings, not equity, borrowed money that must be repaid. OpenAI's $1.4 trillion data center commitment is funded against projected future revenues that don't yet exist at the required scale. The hyperscalers face a prisoner's dilemma. If Amazon reduces AI investment, Microsoft might capture market share. If Microsoft reduces investment, Google might win. So all of them continue spending beyond what current revenues can sustain. Google's own CEO stated, "The risk of underinvesting is dramatically greater than the risk of overinvesting." That logic made sense in 1999, too, until the funding stopped. Liquidity triggers. What transforms an overvalued market into a liquidity crisis? Two triggers are building right now. First, revenue disappointment. If major AI companies report earnings below the extraordinary growth already priced into valuations, institutional investors will reduce their exposure. When 30% of the S&P 500 is concentrated in 5 companies, institutional de-risking moves the entire index. Second, the DeepSeek effect replicated. January 2025 proved that a single competitive announcement can erase $600 billion in one afternoon. If Chinese AI development continues compressing the cost of AI capabilities, the competitive moat justifying trillion-dollar valuations narrows rapidly. Conclusion. The dot-com crash wiped out $5 trillion over 2 years. It also revealed a permanent truth. Transformative technology and profitable investment in that technology are not the same thing. The Internet changed everything, but between 2000 and 2022, even Amazon and Google lost 90% of their value, and hundreds of companies building genuine Internet technology ceased to exist entirely. Sam Altman, CEO of OpenAI, stated in 2025 that he believes an AI bubble is ongoing. Ray Dalio said current AI investment levels are very similar to the dot-com era. Jamie Dimon warned that an AI-driven stock crash could result in significant losses, even as he acknowledged AI will ultimately pay off, just as the Internet ultimately paid off, and most people invested in the Internet in 1999 did not do well. The question for 2026 is not whether AI will transform the global economy. It will. The question is whether $500 billion in annual spending, funded partly by debt, against $50 billion in current revenues, inside a market where 5 companies control 30% of the entire index, creates the conditions for a liquidity crisis when sentiment shifts. History says yes. The mechanism is identical to 1999. The scale is larger. The interconnections are deeper. The only difference is that this time, everyone sees it coming. Whether you act on it before the selling begins, that's the variable history cannot answer for you. If this investigation revealed a pattern you hadn't considered, subscribe now. Every week, we dissect another hidden fault line in the global financial system, examining the evidence before it becomes the next crisis. Drop a chart emoji in the comments if you're watching these numbers in 2026. This is Financial Forensics. We read the autopsy, before the patient dies.